going over how I'm analyzing this property. With this, I'll be using Rent Meter to kind of get a better idea of where things are at on that front. And then when it comes to essentially going into this, you can basically use BiggerPockets has a similar calculator to this. This is just a personal calculator that I created. And right now, this is a duplex that we're analyzing that has taxes around $6,663. Right now, the list price is around $800, and then I have it so that way, in my equation, essentially, it will add in the rehab along with the list price, just to kind of give a general idea of what the ARV is. Typically, just know that the ARV doesn't always match adding in the rehab costs, so just something to keep in mind. And with this, I already did run it through Rent Meter, but essentially you just add in the address, add in the bedroom, and then number of baths, enter in the address, and then analyze. You get up about 5 of the test ones, so just something to kind of keep in mind that you have 5 per month when you are analyzing. You can always upgrade to Pro to get a little bit more of the professional one, to get a little bit more analysis into this. You can also then actually pick the building type, which is either apartment condo or duplex house. I tend to go always towards the apartment condo, especially with small multifamily. If it is something where it is a single family house, then I will go towards the house aspect, but usually there's a pretty large difference between the prices or the average rents between those two. So with that, I am taking a look at just kind of adding in the initial details first, and then really figuring out, okay, what's the best use or best case scenarios for this. Since this is a 3-1 on both sides, I'm adding in the rents, which is just around 19. So there's the average of 1935 and then the median of 1970. I'm going to go probably closer to the lower. I tend to be a little bit more conservative in general. This is a nicer area, and I also have this where it kind of pulls in all this data as needed. Assuming this is a house hacker using the 5% down, and then for the interest rate, I'd actually even add, usually rates for these are going to be at least a quarter point higher than where things are at right now. So I'd add that plus 0.025. I think that, one more zero in there. Okay. So this way it kind of gives me a better idea of where the rate would be. Closing costs for this would probably be around 15. This would be something you would want to talk to your lender about and identify a couple of subject properties when you are looking and say, hey, what are the closing costs on this? Sometimes they can get wrapped up into the loan, or you just pay them out of pocket. And then when it comes to the appreciation, these are yearly assumptions, which we will definitely get to a little bit later on. But you can see that I have defaults here, and then things where you can kind of change things as needed would be property management, maintenance, vacancy, capital expenditures. So we'll kind of dive into that a little bit when we're looking at the pictures of the house. And then PMI is something to consider. In this case, there's actually an HOA of around 890. Let me double check. Yeah, 899 per year, which definitely did not add in that properly. So that's around $75. Sometimes you can get the mortgage insurance depending on, there's some special loan programs out there that are more portfolio loans. That might be something to look into, where you can pay off some of the mortgage insurance, which can help out a ton, especially if that's a 475 amount. Right now, just with rents and then what the monthly mortgage payment would be, it's still a pretty large difference. So if we're just looking at the monthly PI payment, there's still a large difference between the two. And then if you can see up here what the actual mortgage would be closer to this 6,000, which is definitely a large difference between the two. I mean, we'd either have to get a significantly lower rate or buy down that rate a little bit more. And then on top of that, one thing to note is that when you are doing property management, usually 8% is a good idea. But if this is probably your first one where you're not having to, you're managing yourself, then it's probably going to be a better idea to kind of zero these out. And also just kind of see what it is with the PITI payment minus the total cash flow. Note that you will still want to probably have some of this in reserve depending on where your skill, or maybe not skill set, but how much you have in reserve is something to keep in mind as well. Vacancy rate is definitely something that I would still kind of keep an eye out on, and add some sort of cushion into there on a monthly basis. But if you already are coming into the transaction with this, then that might be something where you're not having to worry about it quite as much. So with that, this is somewhat not super great when it comes to cash on cash return. If we're looking at, we can even probably be a little bit more conservative here and say 3% appreciation on an annual basis. Usually Portland is around 3 to 5% appreciation if you're looking at a 30 to 50 year time frame. And then you can kind of see over time, this is where these yearly assumptions really matter when you're looking at this, where you can kind of see this blue line is when it starts cash flowing. So this is not even really cash flowing until year 11, which is not fantastic. And then on top of that, your annual cash flow, I mean, it would probably get a lot better in that year 30, but that's still a long ways off. And as if you're okay with basically absorbing the annual loss, that might be something that might be fine to you, because it's more of an equity play. Just in general, when it comes to metropolitan markets, it's much more of an equity play. But that's still a lot of cash to be losing, especially up in the first like 10 years. Now, if it broke even, maybe closer to I would say 2 to 3 years, then that's actually pretty good right now in Portland, given the rates and where everything's at. But let's say, for example, you're an investor 25% down, no PMI insurance at that point, or mortgage insurance, it makes a lot more sense in terms of cash flow, but it's still not even cash flowing until year 5, essentially. But you can kind of see how much of a difference, and I'll just actually expand this, how much of a difference it makes in terms of the cash flow and how quickly it will start cash flowing. Income growth around, I would say around 6% would be pretty comparable. But then when I'm looking at this property, it's a duplex, it's in a nicer neighborhood, and also you can usually check out niche.com has a great way to kind of see where the schools, crime, things of that nature, and is typically where I will have people go to just to kind of see things. One kind of downside, and this would be something I would definitely be diving into a little bit more, would be the HOA and seeing what that entails. Looks like there's a pool involved. However, I'm curious about what the restrictions might be, and what kind of limitations there might be for each one. Looks like new roof. So for roof and gutters, which means that's a huge expense. I mean, if we're looking at this, this is a pretty large roof. I would say probably a rough estimate would be 25 to 30 grand to replace. Again, this would be something where I would reach out to roofers to get a better idea. But if that's the case, then it was replaced in 2017. Usually it has about 20 to 30 years on it. A lot of newer roofs especially have closer to that 30-year mark. So that's good. They did renovate one of them. You can kind of see the bamboo floors that they've put in place. You can see the cadet heaters. It looks like they kind of made this fireplace look a lot nicer, and then updated some of these. The kitchen, nothing massive. Definitely looks like older kitchen cabinets, and then they just put new hardware, which actually is a really good idea. I think the countertops, the laminate countertops, would be something I would switch out to something maybe a little bit more modern. They have gotten a lot better about these in general. IKEA actually has some great countertops that are still, they look a little bit more modern and they look less dated, in my opinion. I actually installed these in my duplex. So, kind of looking at this, it does have a yard, which is nice. I'm curious on whether or not there's a separation between the two of the yards. That would be something that actually is a big selling factor, especially if people have pets or things of that nature. Looks like there's carpet in the bedrooms, and then in one of the closets there's going to be the laundry room, which is good. So it does have this nice cedar deck, but the windows look a little bit more updated. But I don't think, based off of this, I am not sure whether or not there is a separation between the two units with a fence. So something just to kind of consider. And then This definitely needs a lot more updating. So usually this is a box ceiling, which means that it's empty. It's still a pain in the butt to essentially tear out, and then you have to put drywall back over it. So that way you can have these higher ceilings and maybe move these cabinets up a little bit more. You can see that these are actually very similar cabinets to the previous one. Or the previous unit, and then this is definitely something that needs to get updated, and also has a washer and dryer in here, which I think would probably be better to remove that and then put it in a closet or something like it is on the other unit. I can notice that there's some popcorn ceilings that may or may not be something that I'd replace. Honestly, if they're not being disturbed, they're usually not a huge problem. So just something to kind of consider. And then it does have parking in a garage, which is a big thing. I think I would want to take a look at the floor plan and then really see where the bedrooms land, because usually, in my opinion, I think it's better to have the bedrooms on separate sides when it comes to duplexes, just because of the fact that you're going to have a little bit more separation in terms of sound and things of that nature. And then when there are maybe noisier things, they're right next to each other, so it's not something where you're going to have to like worry about someone having a little bit louder music playing in their bedroom or something of that nature. So with all of that, kind of taking a look at the calculator again, this would be something where I'm taking a look at property management. Again, if we're looking at a person who's managed for the first house act, something like that, I'd zero this out. I do think that the capital expenditures, which is the roof, water heater, siding, things of that nature, bigger, larger expenses, I do think that this would probably be closer to that 2 to 3%, depending on what risk tolerance you have. Again, this is why I have the defaults at a higher amount, but when you're kind of looking at this and analyzing deals for yourself, this is something where it's extremely personalized, and typically why I will go over these calculators with people and understand their risk a little bit more and kind of provide them feedback as we're kind of going through this. Maintenance wise, this does have trees. I'm not sure if the HOA really covers that for the most part. I don't think so. I think it's more for, like, it looks like there's a pool and a couple other things that it'll cover. So I would say it's still 2%, and then probably I would say like 4 to 5%. This is an area where I wouldn't imagine it staying on the market for too long, but something to just still consider. Even with all that, it's not cash flowing super well. I'm looking at this and I just don't think it's. I personally would not invest in this. However, if it's something where you're having enough money down, that 25%, it might make sense. But for right now, I don't really find this super like a great deal, in my opinion. So with that, if you have any questions about this process, I'm going to try to do this a little bit more frequently, so that way you can get a better idea of how to analyze deals and what I'm looking at when I'm looking at this. One other thing I would probably bring up would be just looking at the map, seeing if it's on a busy street, because that does become a little bit more of a deterrent when you're renting it out. And then also on the resale value, location does play a large role in that, and you can't obviously move the property. So something to keep in mind, especially when you're looking at the type of tenant you're willing to deal with. Usually when you are going with tenants that are in certain, like single family homes, for example, will attract a certain type of tenant, and they have their risks and benefits with that. Same goes for a variety of different strategies you can use in terms of using short-term rentals, or if you're looking at a single family house and then using an ADU that's on there. And then you can also look at midterm rentals for, like, for example, traveling nurses and doctors. So something where I'm kind of looking at this, but there's not a ton you can really do from a long-term tenant perspective. And usually short-term, you might be able to get away with, given this location, maybe a midterm rental that's furnished. You can use furnishedfinders.com is a great place for basically posting this. From my knowledge and my understanding, usually short-term rentals don't do as great of a job when it comes to the short-term rental side, unless they have like something that's super unique about them. That would be really beneficial, but in this case, I'm not saying anything super special. And then also there might be something that pops up with the HOA rules that might basically ding this or make the short-term rental not really a possibility. So with that, if you have any other questions, feel free to reach out, and I'd be more than happy to answer any questions you got.